Hey guys, we are talking about Canopy Growth Corp in this video. Now I've covered Tilray, High Tide, and ACB now in my last two videos, and you should really check them out if you're deciding on whether you want to invest into the cannabis space. It's important to pick the right company. And so Canopy Growth Corp, is it a buy, is it a sell, is it a hold? But we are going to find out, and to do that, we will do some fundamental analysis on this company to see if they're worth that hefty price tag that they hold right now. And then at the end, we will go through revenue and share price projections to see what the model tells us. So looking at Canopy Growth Corp, ticker WEED and CGC, the company trades on the TSX and NASDAQ exchange with a market cap of over $10 billion. And it's the largest cannabis company that we've looked at. And moving right along, the company's growth in the early days looks similar to many of the others in the space. It spiked during that run in 2016 to 17. They were growing their revenues by an impressive 570% in 2016 and almost in the triple digits every year following until 2020. But something important to note is that the company's gross profits did not grow. In fact, they shrunk. And this was due to their gross margins dropping very dramatically from 42% down to 12.5% and 26.4%. And I think what happened here with Canopy definitely hurt the sentiment of the weed industry. They were seen as one of the industry leaders, but showed no signs of improving along their path to profitability. A reason for this, though, was due to the company looking towards a massive expansion, creating new products like cannabis beverages and opening new plants worldwide in places like Africa and other parts around it. And this resulted in the company increasing their operating expenses by 149%, 271%, and 220% during 2017 to 19. So at this point, the company's margins shrunk, operating expenses ballooned, and this led to losses being posted at alarming numbers. You can see 7.5 million to 67 to 736 to 1.3 billion in just 4 years. The new CEO, David Klein, has stated that he plans to shift the company's focus from growth to profitability. You can see a very strong cash position of 2.48 billion and a total asset count of 8.56 billion in 2018. They were really ahead of their competitors at this time, and the stock was doing well during that period. But they had just expanded too fast in the industry that was still too young and had not matured. They were seen as one of the leaders in the industry and had all the capital and support, especially being backed by Constellation Brands. Even after all those blunders, you can still see they have a very strong balance sheet, a lot of cash sitting at 1.3 billion to end 2020, and only short-term debt of 420 million. But still, you see this giant deficit in their retained earnings, and that's not going away anytime soon. Yes, they've downsized and laid off employees to cut costs, but they went too far and overreached in their business strategy and are going to feel it for the next couple of years. The company is far from making any money, and as much cash as they have, the rate at which they are burning it should make all investors feel uneasy. Typically, you would think there's safety in buying a larger company, and it's great that they've got all this cash and all these assets, but how long is it going to take to get there? I'm finding that this company needs to turn too many things around to make me ever want to go near them, yet invest with my low accounting salary on them. And I think these next 2 years are going to be very telling of what is going to happen to the company that was once set to dominate the weed space. Q1 earnings for Canopy Growth, 148.4 million in sales versus 152.5 million in the previous quarter. And this is a 38% increase in net revenue year over year. Still, they missed analyst expectations yet again. The company mentioned that they were hit by a number of headwinds, including 1, weaker sales due to provinces due to the pandemic, 2, customers choosing discount weed products, and 3, a declining overall share of the Canadian legal market. They booked a $617 million loss in a quarter versus $829.3 from the previous. And this was definitely less than the $1.3 billion loss from a year ago. So the company also gave a guidance for next year. They are sticking to their claim that they are on track to turn a profit next year despite doing worse. And so while it's great that the company is very hopeful, I wouldn't be happy as an investor seeing the results go the other way. I am now looking at multiple quarters of poor performance that is not improving. Now, if I were invested in this company and I'm down more than 20% or more, I would probably just brave out another quarter or two and see if there really is improvement to be had. And if there were 2 quarters further down and everything stays the same, then I would be real scared. Okay, so here I have a projection of Canopy Growth Corp, and like all my models, it projects until 2027. I'll go over my assumptions on how I got these numbers and what to expect in the future from this company. So Canopy Growth Corp did $546 million in revenue in fiscal 2021. Management guidance gave a target of 40 to 50% compounded annual growth rate from 2022 to 2024, which is actually a pretty good amount of growth for a company their size. This will mean that they hit that $1 billion target by 2023. And in terms of expenses, this increased quite dramatically in 2021, but is expected to level off in the next few years as management has noted that they will be in the cost-cutting phase for quite a while. For G&A, this was another line item that the company highlighted in their focus to reduce. And you can see they made an effort in 2021 as it's fallen 20% from the previous year. Depreciation, same again. They closed down a lot of plants to save money, and this changes quite a bit. And I don't expect them to make any significant investments until after they turn a profit. And this goes for R&D as well. And went down and isn't expected to climb much until later. Stock-based compensation, this one they highlighted because there was a larger than 70% reduction in stock-based compensation, which makes sense, you know. The management team has done more to hurt the company than actual good at this point. And the last line item that I'll cover is the other non-operating income or expenses. This spiked pretty high from what I presume to be the company liquidating their assets, and I think these additional cost-cutting measures, it should stay positive in the medium term. As for the other items, feel free to pause and have a look. There aren't too many tiny amounts, I know, but there just isn't much I need to say about them other than projecting them to trend at levels that I find reasonable. On to my favorite, as always, share price projections. The range that we'll cover for Canopy will be 12.5 to 17.5 times revenue. As of June 1st, they are trading at around 15 times. And over here, when we look at the 2022 column, this is pretty in line with what the stock is trading for. And this is very expensive. Aurora Cannabis, a company that I just covered in my last video, was trading at around 8.6 times revenue, which is almost half of that. So you are paying a higher premium on this company. And the share prices you see here are not conservative. In fact, I feel like they're on the more optimistic side. I followed the company's guidance as mentioned earlier, and right now, just from what I've seen so far, I am a little skeptical, and so they will have to prove me wrong on this one. My predictions for the stock though, I can see them gradually making the climb into the 30s and 40s a year or two down the line, and ultimately ending at a share price of around $87 to $100 per share by 2027. I grayed out the boxes below because it doesn't seem reasonable for the company to be trading anywhere over 15 times revenue while only growing their top line at 20%. Okay, so I'm going to say that Canopy Growth has a lot of things that they need to work on. There are better players in this space who, one, aren't as expensive, and two, won't have to restructure in the way this company is trying to right now. So that's it for this one. If you enjoyed this video, please like and subscribe to the channel and share it with your investing friends who want good fundamental research. We'll see you next time.